Let's face it, we all dream of financial freedom. It's a universal aspiration, a vision of a life unburdened by the constant stress of bills and expenses. We imagine a life where money isn't a constant worry, where we can spend our days doing what we love, surrounded by the people we care about the most. A life where we have the power to pursue our passions and live life on our terms, whether that's painting in a sunlit studio or hiking through breathtaking landscapes. For many, this dream includes building $1 million portfolio, a financial cushion that provides security and opens up a world of possibilities. It might seem like a distant goal, something only achievable by Wall Street experts or lottery winners, those who seem to have a knack for turning money into more money. But here's the truth. Building $1 million portfolio is achievable for anyone willing to learn the ropes and stay committed. It's not reserved for the elite or the exceptionally lucky. It's not about hitting the jackpot overnight or having a secret formula. It's about understanding the principles of investing and applying them consistently. It's about making smart choices consistently over time. Choices that may seem small in the moment, but compound into significant gains. It's about understanding that small steps, taken consistently, can lead to extraordinary results. Just like saving a few dollars each day can add up to a substantial amount over the years. Think of it like climbing a mountain. The journey is long and requires effort, but each step brings you closer to the peak. The peak might seem daunting from the bottom, but with each step, you get closer to the summit. Every small action you take is a step towards your financial goals. This guide is your roadmap to reaching that financial peak. It will provide you with the directions and strategies you need to navigate the complex world of investing. We'll break down the seemingly complex world of investing into simple, actionable steps. You'll learn how to make informed decisions that align with your financial goals. We'll explore proven strategies that can help you build $1 million portfolio from scratch. These strategies are tried and tested, designed to help you grow your wealth steadily. No matter where you are in your financial journey, whether you're just starting out or looking to take your investments to the next level, this guide will empower you to make your $1 million dream a reality. It's never too late to start, and every step you take brings you closer to your goal. Remember, the journey of 1,000 miles begins with a single step. Each decision you make today sets the foundation for your financial future. Today, you take that first step towards financial freedom. Are you ready? The path is laid out before you, and with determination and the right guidance, you can achieve the financial independence you've always dreamed of. One of the biggest misconceptions about investing is that you need a lot of money to get started. This simply isn't true. In fact, starting small can be incredibly powerful, thanks to the magic of compound growth. Compound growth is like a snowball effect. When you reinvest your earnings, those earnings generate their own earnings, and so on. Imagine you invest $100 today, and it earns a 10% return, giving you $110. The next year, you reinvest that $110 and it earns another 10%, giving you $121. See how your money is growing exponentially? This is the beauty of compounding. The earlier you start, the more time your money has to compound. Even small contributions made consistently can add up to significant wealth over time. It's like planting a seed. It might seem small and insignificant at first, but with consistent nurturing, your regular investments, it grows into a strong and fruitful tree. Don't underestimate the power of consistency. Setting aside a small amount each month, no matter how small, is far more effective than making sporadic, large contributions. Remember, the key is to start today. Time is your greatest ally in the journey to building wealth. Let's imagine you're at a carnival and you're about to play a game. You have 10 balls and you can throw them at any target you want. Would you put all 10 balls on one target, hoping to win the biggest prize, or would you spread them out, aiming for different prizes? Most likely, you'd spread your balls out. That's because you intuitively understand the concept of diversification. Diversification in investing is all about spreading your risk. Instead of putting all your money into one stock, bond, or asset class, you diversify your portfolio by investing in a variety of assets. Think of it as creating a safety net for your investments. If one area of the market isn't doing well, you have other investments that can potentially offset those losses. Diversification doesn't guarantee profits, and it doesn't eliminate the possibility of loss. However, it can significantly reduce the impact of market volatility on your portfolio. There are several ways to diversify your portfolio. You can invest in different asset classes like stocks, bonds, real estate, and commodities. Within each asset class, you can further diversify by investing in different sectors, industries, and geographical regions. Remember, diversification is not about trying to time the market or pick individual winners. It's about building a resilient portfolio that can weather market storms and grow steadily over the long term. By diversifying your investments, you're setting yourself up for a smoother and more predictable journey towards your million-dollar goal. Just like at the Carnival, where spreading your throws increases your chances of winning something, diversification in investing increases your chances of achieving financial success. It's about understanding that not every investment will be a winner, but having a mix can help balance out the losers. Historically, diversified portfolios have shown more stable growth over time compared to those heavily invested in a single asset. Regularly reviewing and adjusting your portfolio is also a key part of maintaining diversification. This process, known as rebalancing, ensures that your investments remain aligned with your financial goals and risk tolerance. Diversification is important for investors of all ages, whether you're just starting out or nearing retirement. It helps protect your hard-earned money and provides a more secure financial future for you and your family. So next time you think about investing, remember the Carnival game. Spread your investments wisely, and you'll be better prepared to handle whatever the market throws your way. Diversification matters, and it's a strategy that can help you achieve your financial dreams. You don't need to be a stock market guru to build wealth. Many people think that investing is only for the experts or those who have a lot of money to spare. But the truth is, anyone can start investing and build wealth over time. In fact, one of the most effective and accessible ways to grow your money is through low-cost index funds. These funds are designed to make investing simple and affordable for everyone, regardless of their financial background or experience. Think of index funds like a basket of stocks that track a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. These indexes represent a broad segment of the market, giving you exposure to a wide range of companies. When you invest in an index fund, you're essentially buying a small piece of all the companies in that index. This means that your investment is spread across many different companies, reducing the risk associated with investing in individual stocks. Index funds offer several advantages for investors, especially beginners. They are a great way to start investing without needing to know a lot about the stock market or spending a lot of time managing your investments. First, they provide instant diversification. Diversification is a key principle of investing because it helps spread risk across different assets. Instead of buying individual stocks, you're investing in a diversified basket of companies, which helps reduce risk. This means that if one company performs poorly, it won't have a significant impact on your overall investment. Second, index funds are typically very low cost. The fees associated with these funds are much lower than those of actively managed funds, where fund managers buy and sell stocks frequently. They have lower expense ratios than actively managed funds, which means more of your money is working for you. Lower fees can make a big difference in your investment returns over time. Finally, index funds are simple to understand and manage. You don't need to be constantly monitoring the market or making frequent trades. You don't need to spend hours researching individual stocks or trying to time the market. This hands-off approach makes it easier for you to stick to your investment plan and stay focused on your long-term goals. You simply choose an index that aligns with your investment goals and invest consistently over time. Many investors set up automatic contributions to their index funds, making the process even more effortless. Index funds are like riding a wave. Just as a surfer rides the natural movement of the ocean, index fund investors ride the natural upward momentum of the market. Instead of trying to swim against the current, you're riding the natural upward momentum of the market. This approach allows you to benefit from the overall growth of the economy. While there will be ups and downs along the way, history has shown that the market tends to go up over the long term. This long-term growth can help you achieve your financial goals, whether it's saving for retirement, buying a home, or funding your children's education. By investing in low-cost index funds, you're harnessing the power of the market to grow your wealth steadily and efficiently. Over time, the compounding effect of your investments can lead to significant growth, helping you build a secure financial future.